All right, good morning to the Naturally San Diego community. My name is Kirsten Riley. I am Executive Director of Naturally San Diego. We have RSM here today talking about the R&D credit and then the tax offset associated with that. I want to give a couple quick shout outs. We have Jason Podaliccio here with us, who is an RSM board, or excuse me, a Naturally San Diego board member and a new partner at RSM. And we have Connor Leckman here, who is a Natural San Diego Programs Committee member. And he is in audit, right, Connor? Audit? Tax audit? So
Yep,
I'm gonna let Connor take it from here. He's gonna introduce Nick and Talia, and we're gonna kick off all sorts of R&D credits.
perfect. Thanks, Kirsten. Good morning, everybody. As Kirsten mentioned, my name is Connor Leckman. I'm a CPA and audit manager for RSM. I work out of our San Diego office up in Torrey Pines. Brief little quick plug on RSM. We are in over 80 offices across the U.S. and in 120 countries globally. As the largest audit tax and consulting firm focused on the middle market in the U.S. and globally, our approach to client service is rooted in deep industry knowledge and technical acumen. Our first choice advisors do not just provide services, they bring diverse perspectives, innovative ideas, and data-driven insights to all of our clients. I've personally been with our firm for about 8 years. I do work in a handful of industries, but my main focus is consumer products, which is how I got involved with Naturally San Diego. I've been part of Naturally San Diego for probably 4 years now. And as Kirsten mentioned, I recently joined the program committee and will be leading the webinar series for 2025. Hopefully beyond that, but I'm sure that's dependent on how the series goes this year. I'm hopeful to get some folks on here to share unique information and perspectives from not only RSM and other business service providers, but hopefully also brand leaders as well to share insights, lessons, and all-around advice with the Naturally community. With that, as Kirsten mentioned, we have Nick and Talia here from our firm to present on some interesting tax topics today. Before I pass it over to them, I wanted to mention, feel free to drop any questions in the chat. We'll go through those at the conclusion of the presentation. And without further ado, Nick and Talia, I'll pass it over to you two if you'd like to introduce yourselves.
Hey, will do. Thank you very much. Also, besides the chat, if you want to unmute yourself and ask a question, feel free to interrupt at any time. So Nick Avakian here. I lead the tax department for RSM in Southern California. I also lead the West Coast practice for tax credits. Been here for 20 years, and the entire time I've been focused on the R&D tax credit, pretty much just that one code section and the ancillary code sections around it. So kind of deep expert in that area. In my prior life, I was in technology, software development, database design, weather stations, you name it, point of sale, ERP. Did that for a while and kind of naturally transitioned into the R&D tax credit because of that. Talia?
Thanks, Nick. I'm Talia Kirstein. I'm a senior manager with our R&D tax credit practice. I'm based down in Orange County. I've been within the R&D world for about 10 years. I actually came from an engineering and STEM background, made my way into the legal field and tax law. That kind of gives that perfect balance combination of STEM, tax, and law, what you really need for an R&D credit. My focus is consumer products, food and beverage, and software development. So hopefully we can share some great information with you guys today. And like Nick mentioned, if anyone does have any questions, feel free to jump in at any time.
So like we can just interrupt you right away and just like raise our hand. What's the etiquette here?
There is no etiquette. This is a casual conversation. There aren't too many of us on here, so if we had a couple hundred people, it'll be a little different. But yeah, if you want to jump in, ask a question, go for it.
I'm going to save my audit questions for a little bit later. So I'm going to wait till we get to the end because I have a rather spicy question to ask the team about just in terms of your core competencies. Maybe save this one for Connor, maybe give it to Talia. I'll leave that up to later, but let's get into the presentation. That'll probably inform my questions a little bit, but thank you.
Okay, sounds good.
So you can all see our screen here.
All right. So what might qualify? It's the question everybody asks at the start of an R&D project. We usually scrub for all these different things, and for some clients it might be only be a couple of them. Others it'll be quite a few different things. But new product development, this is the classic new. It could be anything. All the tangible goods around you. It could be food and beverage, like we're talking about for most of these cases. It could be packaging. It could be a new type of popcorn or a sauce, or we have a lot of experience with beans, if you can believe it. So new product development is the classic definition that the tax code was written for. And then it kind of evolved into product improvement. So if you have an evolution of a product, maybe you want to improve the shelf life, or you want it to be more robust and have a different kind of texture, or a different flavor profile. All those things qualify as you make improvements to existing products. And then you've got process development. So how are we, like I mentioned beans a moment ago, if you develop the perfect type of beans that are meeting your criteria for your customer, in the experimental sense, maybe making 5 or 10 gallons of it, and now you want to scale it up to 100 gallons, and then you may want to make it for processing. How do you pump that from one place to another without turning it into refried beans? So the process around and the scale up for manufacturing qualifies. And the last one is software development. We see that in almost all of our clients, whether they're developing some software themselves or they're having someone develop it for them. Both of those qualify.
And Nick, I think I saw Sean's hand pop up, so I don't know if you have a quick question there, Sean.
I actually did. I didn't think I'd be interrupting so quickly. So if I say have a nutrition product and I'm reformulating it and considering different ingredients for it, I take it through a pilot run to test it on various equipment to make sure it moves into the packaging well. And, I spend, say, $30,000, $40,000 to do so. You're saying that may qualify.
Yes, but more than likely parts of that will qualify and parts of it won't. The portion, and we'll get into the qualification factors in just a minute, but overall as a project, I would check that and say, yes, we need to analyze that, because there will be portions of that that do qualify. And to your point, you might be trying different combinations of ingredients or whatever it is, but you might be going to a different supplier for the same ingredient. And when you do that, you need to go through this process of testing. As long as it's not quality control and you have some sort of uncertainty around it.
Oh yeah,
again,
100%.
We'll get into the qualification, but so we're taking a broad stroke here. Anytime you make changes to what you're doing, we should analyze that to see if it is R&D. And in some cases it won't be, but in most cases, part of the project will be.
Cool. Good to hear. Thanks.
All right, so getting into the details of the types of expenses that we can capture, and Sean, this might hit on some of your costs that you mentioned. There's 4 main expenses that we can look at. The first and generally the largest component is employee wages. Any employees that are working on your development in one of 3 levels that we'll talk about in a moment could have some qualified R&D spend. So we take the box 1 W-2 wage amount, throw that right into our calculation at how much time they're spending. Usually it's a percentage of their time. So those 3 levels that you see are direct R&D. That's going to be your formulators, your engineers, your product developers. That's the boots on the ground, hands-on R&D. 1 level up is the direct supervision of those employees. So that's your team leaders, PMs, maybe your head of manufacturing or head of development that isn't doing the R&D directly, but they're supervising, offering technical guidance, really helping set the stage for the R&D process. We're able to capture their time, as well as 1 level below of direct support. These are the folks that you wouldn't think are typical R&D staff, but they're part of the process. They might be running some pilot scale batch testing for you. Maybe they're manufacturing employees that are on the floor. They might not even know that they're doing pilot runs and prototypes, but it's all part of that process. We're able to capture that time as well. The example that the regulations like to give for direct support is you might have a chemist in a white lab coat making a new pharmaceutical. That'd be the direct R&D. But if you have a janitor who comes in to clean the beakers, set up a new testing environment, that's all part of the process. You can't accomplish the R&D without that task. So we're able to capture that janitor's time as well. The next category is supplies that are used in the research process. Scrap materials, testing batch products, anything that you're using or consuming in the R&D process, we're able to capture that really as your testing expense. The next one there is contract research. Any third parties that you're hiring to perform R&D on your behalf. In the food and beverage space, it's usually testing labs or outside vendors who are helping do some development for you, formulators. As long as you maintain the financial risk, meaning that you're on the hook for the cost. If you're paying a testing lab $5,000 to do some shelf life stability testing, and it fails, you still have to pay that cost, and you're eligible to claim that, as well as holding on to the IP and the rights to use the results of the research. So when we're looking at some vendor expenses, sometimes we have to look within the contract or the agreement, make sure that the eligibility is there, and we're able to capture a portion of that contractor spend. The last category on the bottom, computer rental or lease. When the R&D credit was first established in the 80s, back when people were renting their computer space, big server rooms, that definition has since evolved into cloud computing. So any cloud computing spend, AWS, Microsoft Azure, Google Drive, that you're devoting to R&D development, even if you're making a new internal CRM or ERP system, some of that cloud spend that's going to the development team can be captured for the credit as well.
So Sean, do you want to take that 30, 40,000 that you mentioned earlier and kind of go explain where those expenses are, and we can talk about them in the kind of expense categories that we have here?
Well, yeah. So raw materials used in the R&D process would be number one. We took an electrolyte product that we have, and we basically tore it down to the studs. So we stopped working with every supplier who had done our original production run, our original go-to-market, and we said, hey, we have to rethink this product. So we have all new raw materials. We have wages, both full-time employees and consultants that lent their expertise in development of the product. And this was, combining various different ingredients, magnesiums to potassiums to different salts to sugars, seeing how they interact. Is it shelf stable? Does it clump or agglomerate? Or are there other issues within how the product works that you need to make sure are stable? And then you take that all the way through to a pilot run. Pilot runs are a rather expensive process where you're actually physically making a simulation of your end product. In this case, they're little stick packets. So in order to make a stick packet, you actually have to make at least a couple thousand sticks to justify turning the machine on. So it's a rather expensive element, but you also need to make sure that the product blends well, makes it into the stick, and can hang out there and be what's referred to as shelf stable. So we went through that whole process, and it's a blend, absolutely. So where we saw the fees predominantly from employee wages, contract, I would call it contract research, although they didn't actually charge for that component. They charge you through your actual production. So it's sort of a hidden fee, if you will. But certainly the raw material costs.
Yeah, the raw material costs would definitely qualify. What happens to those packets after they're produced, the prototypes?
We give them away.
You give them away? Okay.
Yeah, so I would send some over to yourself. I'll send some to Kirsten. I'll send them around to friends of the brand. I also use them at a sales meeting as samples to engage. We're work a lot with Major League Baseball and professional teams in baseball. So we flew to the baseball winter meetings and we handed them out to various teams in baseball. So, the Angels, the Red Sox, the Yankees, we would give them these pilot samples and say, hey, this is representative of a product we're going to bring to market to service your players. And a big opportunity to get flavor feedbacks and kind of informal data on performance, any other qualities that we're interested in.
All right. So as far as contract research goes, since you weren't paying for that, it's kind of built into the cost. Unless it's a separate line item, we'd have trouble including that. But we could if it was significant enough and it was worth the effort. So were there any other contractors included in this operation? I mean, like somebody that's maybe a 1099, or you're sending it out?
Yeah.
Sort of
yeah,
testing?
100%.
All right. So 100%. All of that expense would qualify as well. There's a little bit of a haircut that we have to take, but we won't get into that. It's part of the kind of calculation.
Sure.
Supplies are easy. There isn't a whole lot to that. You know what supplies are going in and whatever the costs are associated with it. The wages are where it gets a little bit more tricky. As Talia mentioned, we've got the individuals that are kind of frontline direct R&D, the ones that are, low-hanging fruit. They're doing R&D. There isn't really that much of a question. They're the ones that are mixing it up. They're the ones that are coming up with the formula. They're the ones that are making it happen, right? But direct performance isn't what we don't spend a lot of time there because it's so easy to find. It's the direct supervision that we spend a lot of time on, probably some of your time, and other leaders that are coming up, all the way from the very start. What are the requirements for this? Somebody says, could even be your sales team, says, hey, if you can make this for me, I can sell a lot of it. So I want something that is kind of in this world. I want it to be whatever, lemon, lime, extra magnesium, a little bit less potassium than we have in this other product. And so the salesperson time could actually be included as kind of a supervisory role. And as it goes through, people that are signing off on development meetings, all those things, all those individuals, when they spend time on development, it qualifies. When they're spending time building relationship, sales, you're managing the business, finance, dealing with the insurance agent, sure, that doesn't qualify. But when you're focused on the R&D, the leaders of the company that are supervising this effort, their time qualifies. And so we typically see wages are higher for supervisors than they are for support. So we try and capture as much of that as we can. And then the supporting role, kind of the janitor example for the chemist in the lab that Talia gave, it could be anything from somebody that's lugging the supplies from one place to another and helping the individuals that are blending it. We often kind of in a different world, but we'll see like a welder setting up a jig to produce some sort of equipment for production. And that welder's time is qualified as well because he's setting up the jig and experimenting with different things and kind of creating that prototype.
Cool.
So any questions from anyone else or you too, Sean, or about expenses that we can capture?
Well, looking at the utilization and really the tax side of the credit is how are we able to put that on the tax return? So with the federal credit, you can offset your tax liability. It's a dollar for dollar credit. The credit ends up being roughly 8 to 12% of your spend. So if you've got $1 million in R&D expense, you could look for around $100,000 benefit. And if a company is in losses, maybe you're pre-revenue, you could potentially offset your payroll tax or a portion of your Medicare tax if you're a qualified small business. So we're seeing a lot of new food and beverage companies try to take advantage of that payroll tax offset. It actually increased. It used to be up to $250,000. It's doubled to $500,000 last year. So we're definitely seeing a lot of activity in the payroll offset. When it comes to states, different states that offer credit, there's about 35 states, including California. So you're able to get a little added benefit of a state tax credit. And then this last bullet here of capitalization. Starting in 2022, or prior to 2022, you used to be able to immediately expense and deduct all of your R&D costs. Beginning in 22, you now have to capitalize them over a 5 or 15-year term. One of the benefits of going through an R&D tax credit study is those calculations can be run concurrently. A lot of the information is taken from the same resources. So if you've got that spend US R&D, or in here you'll see it says R&E, it's actually a different definition. R&D is for the tax credit, research and development costs. R&E is your research and experimentation. It gets a little bit into the weeds of the difference between these costs. But there is a capitalization requirement now. So US spend, it's going to be capitalized over a 5-year term. International R&D, if you've got maybe manufacturing facilities, across the border, it'll be a 15-year term if they're doing any of that pilot run production or a prototype development. So we do like to run calculations concurrently just to improve efficiencies really on the tax side.
And so what's interesting here is that they're kind of working against each other. You've got the R&D credit that's providing a dollar for dollar tax credit. And in 2022, when this started, we are expensing over a period of time instead of immediately. So it's a timing difference in terms of the expense related to R&D or R&E. And it was part of the TCJA 2017 Act to pay for some other benefits that were provided. And we were all hoping that this would go away before it was effective in 2022. Unfortunately, that hasn't changed. We have bipartisan support to get that back to retroactively go back to 2021. and kind of eliminate all these things, but it hasn't happened yet. Fingers crossed it will pretty soon. I'm actually meeting with a member of Congress on Saturday. He wants our firm's opinion on how they should modify the tax code in order to go back to the kind of 2021 regime that we had before this expense requirement was modified.
All right. Well, moving
Nick,
into
sorry, really quick. Interrupt you super quick. Could you define what a qualified small business is in the quotes in that previous slide?
back up. Yeah, the qualified small business is if you have no more than $5 million of gross receipts within the last 5 years. And the gross receipts definition depends on the entity type, but really we're looking for in any of those 5 years, no more than $5 million. So it's a true startup is able to capture this payroll tax offset. Once you get above that threshold, unfortunately, you're knocked out of qualification for it. And at that point, you'll just start looking at how do I utilize this against my tax liability. And if you are in losses or if you don't have a tax liability due that you can offset, you can carry this credit forward. The federal credit can be carried forward 20 years. The state credit can be carried forward indefinitely. So really, you can just start banking these credits until you get to a point where you're ready to start utilizing them.
So, and this was put in place because with the traditional credit, the way it was calculated, you had to be in a taxable position, an income taxable position, in order to utilize the credit. So the startups weren't getting any opportunity to utilize it. They were just carrying it forward for 20 years, like Talia said. So it wasn't very exciting, and it didn't help out in the startup phase. So this is what Congress came up with to help out during the first 5 years.
Yeah, and typically those startups have a really large portion of development expenses, really getting their products off the ground. All right, so looking at the definition of R&D, when we look at these qualified projects, it needs to meet what you see here is the 4-part test. This is the heart of the R&D credit. In order to be a qualified project or business component is the phrase that the IRS uses, you'll need to meet all 4 parts, starting with the upper left corner of permitted purpose. There needs to be some goal or objective. What are we trying to accomplish here? Is it a new product? Is it an improvement? Is it a new technique or formula? This is a pretty easy test to meet. It's really checking the box to say, I'm coming up with a brand new electrolyte blend, or I'm coming up with an improvement on my manufacturing process to increase my shelf life. So the most difficult part with the R&D credit is really just being able to document it, write it down on paper to say, what was the goal? What was the objective? That's hit here in this first test of permitted purpose. The second test, elimination of uncertainty and technological in nature, those two opposite corners, I like to put those together, that there needs to be some elimination of technical uncertainty at the outset of the project relating to one of 3 things: capability, methodology, or appropriateness of design. In the really easy way to phrase it, it's asking the questions, can I make this? How do I make it? What does it look like? In the more detailed and technical sense, it's I'm coming up with this new formula. Is it going to be more or less magnesium? Is it going to have a tear on the top of the pouch? Will that impact the stability and the shelf life? Will that impact the any degradation of the product over time? So it's all of those technical questions. How am I going to get that right flavor profile that I'm looking for? This is where you're going to find the most detail of how a project qualifies for R&D. And with technological in nature, it needs to be what we call the hard hat science. So chemistry, biology, engineering. What we try to stay away from is consumer preference, general business uncertainties, sales, marketing, finance. Like Nick mentioned, anyone who's on the finance team, if they're helping run some documentation for the R&D group, that might be qualified. But just your general sales time, unfortunately, we can't capture. And when it comes to food and beverage, it's a pretty hot topic of what's the difference between flavor and taste. Taste is more consumer preference. I want this to taste good versus bad, won't qualify. But if I need a flavor profile to meet my technical requirements, I've got a new product and I need it to taste like tangerine. I'm going to try 10 different formulations. I might get clementine, orange, mandarin, grapefruit. Nothing's hitting that right flavor profile until I hit tangerine. And this is what we're looking for from a technical standpoint. All of that time would qualify. Lastly, the process of experimentation. These are the steps that we take to try to resolve the uncertainties. This is everything starting with that back of the napkin drawing of this is what we want to accomplish. This is our new production process we want to come up with, or this is our new recipe that we're looking at, all the way through to we're going to make that initial design. We're going to come up with that prototype, get the different vendors lined up for what materials we're going to use. Typically that runs through the point of I'm ready to go to production. Like Sean, like you mentioned, if you've got 1,000 samples that you're going to end up selling, you're still not sure if this product is meeting those requirements, you're still in that process of experimentation. Once you get to the point of saying, we're ready to go, we're in manufacturing, we're in production, that would be the end of the R&D cycle. But with that R&D cycle, we can always kick it off again. Let's say you spent 6 months working on a product, you're halfway through the year and saying it's ready to go, we're in production, and 3 months later, we want to change a flavor, we want to update our manufacturing, we want to do some scale up, exercises to double our production. We're now starting over into a new R&D process rather than the product development. Now we're in product improvements or updates to manufacturing. So while R&D typically it does have that endpoint of we're ready to go and we're selling it out to the public, we can always start that process off again with new improvements, new development. It just becomes the next R&D project.
Does anyone have an example we can go through? A real world example, something you're working on where we can apply the 4-part test and kind of determine whether that project or what portions of that project apply or qualify?
I mean, if no one else does, I can go back to the electrolytes and actually use it as a real world example.
Sure, go for it.
I'll leave that to you guys. All right. So we had this product in market. It's a organic electrolyte made predominantly from or evaporated organic coconut water. It did not work well with magnesium biglycinate, which was the magnesium, and we also tried magnesium citrate. We tried several magnesiums. Magnesium and coconut water powder, for whatever reason, kind of had this like pumping relationship. Second, we used a very natural flavor profile that was very polarizing to the audience. So just, you should know that, we got mixed feedback. It was a love or hate type of product. What we also had was a COGS problem. Organic evaporated coconut water is insanely expensive. We liked it because it was a natural source of 1, potassium, and 2, sugar. And sugar is very important to drive electrolyte absorption within the body. So every time you guys see a sugar-free electrolyte out there, just know that it's going to take your body a lot longer to put those electrolytes to work. And if you're interested in any kind of human performance, a couple of grams of sugar goes a long way. I am not a diet fad person, so I've always thought that 0 sugar is a bunch of horse shit, pardon my French, and a couple grams of sugar is necessary. So here I've got a cost of goods problem, a mixing problem, and a flavor problem. So we decided to scrap the entire hydrate or dye product line about 8 months ago. I said, guys, we're either canceling this project or we're going to rethink it. I chose to rethink it. So I started driving my own innovation on the back of a napkin of how we could make this product better. And I, along that time, also had the idea that all of the ingredients that I'm interested in as a natural electrolyte could actually be sourced and produced from the United States of America. Chloride and sodium from seawater. A natural sea salt carries a ton of chloride and sodium. Potassium is naturally mined in Utah. Magnesiums are naturally mined in both Utah and Arizona. And you can get organic cane sugar either from Louisiana, from Hawaii, from a couple of different states and farms around the United States. So I said, hey guys, we should be able to build this entire formula, including the flavor systems, in the USA. I want made in the USA. So I went to my co-packers, gave them this concept because we're all under NDA. And I said, give me your best and brightest and let's make it happen. Now, here we are in 2025, and I've completely sold out of this product. I've finally gotten it off the store shelves. Sorry, Kirsten. And I'm about to relaunch this product. And I've gone through all these R&D steps to make sure that that magnesium from Utah and potassium from this mine over here and my seawater from the Pacific Northwest and my Louisiana sourced organic cane sugar all play well together. And I had to facilitate a pilot run in order to do that. So was flavor a factor? 100%. Did I have to nail certain flavor profiles to be, available in the market? Yes. And of course, subjectively, I want those to be well received. Was it technological in nature? I would say 100%. We were making sure that different natural electrolytes worked well and minerals worked well together in confined space under various sources, whether it was heat stable, dry, how would humidity affect things. And we had to eliminate uncertainty, because if this stuff clumped up in the packaging, guess what? I'm out of business on that SKU. So that's my little stump speech on what I went through and what we're about to go to market with.
Oh, that's awesome. I really appreciate the example. So, looking at it, kind of putting them more carefully into the boxes, the permitted purpose, this would probably be considered a brand new business component, a brand new project, a brand new item, as opposed to an improvement to the one that you're almost sold out of. But the permitted purpose is relatively easy test. We don't get challenged on that a lot. And then the process of experimentation, that's the whole process of getting it done, right? Getting it to the point where you can put into a package. Typically, there's some documentation along the way, whether it's test results or whatever else that's happening. And that's a relatively easy test as well. The other two are the tough ones. And you nailed it. It's pretty easy in the example that you provided it. What I like to do in general, when you're looking around your shop, is combine those two. And when you see technological uncertainty, wherever you see technological uncertainty, whether it's related to your software systems, or you're talking about production, or you're talking about a brand new product, all those things that are technological uncertainty. If you get nothing else from this presentation, those two words are the ones you want to remember. That will guide you. That's your dividing rod to R&D at your business. So thank you for that example, Sean. That's perfect, spot on. That's clearly R&D. So now, if we were in the process of trying to claim this on your tax returns, what we would do is try and focus on what portion of that project is R&D and what portion is not, because I'm sure there's a lot of sales and marketing and everything else that goes along with it. Finance, do we want to spend the money on it? Budgeting, planning, all those things. Unfortunately, those are not technological in nature by the definition of the tax code. So we have to exclude those activities. So we're really focused on the development. So maybe somebody from accounting who was involved in this, they're probably not included in terms of their wages. So the project qualifies. Our next job is slicing it up to make sure we're only capturing the qualified activities related to the project. And then one more exception. Everything we say today has an exception because of court cases and tax code and everything else and the regulations and guidance. But the exception to that is that if 80% of your spend on the whole project is R&D, so only 20% or 18% or whatever is administratives or sales related or something else that's not qualified, we still get to claim 100% of the activity associated with that project. So we get that 80% of R&D activity and the 20% of non-R&D activity. It's substantially all R&D, so we get to claim it all. And something to look into. We're trying to get every dollar on the table, every bit. If you're going to go through the exercise of putting it on your return, might as well get it all. And there are only a couple little hurdles that you have to pass to get a little bit more. So that's kind of our focus when we're talking about the 4-part test and projects in general.
And Sean, you actually brought up a really interesting element of the R&D credit. When you got to the point to say, are we going to just scrap this and be done with it, or are we going to reformulate it? At the end of every tax year, usually one of 3 things has happened on your project. It's successful and it's out in the market. Maybe you're still working on it and it's overlapped into another tax year, and that's all right. Or there's the third option. We try not to think about the bad memories, but the project could fail. We could say we're not doing it. We're just going to scrap it and move on. The failures are almost there's a silver lining behind them. Sometimes it shows that the technical uncertainty was so high, we couldn't overcome it. We can't get this marketable. We're going to have to just end the project. We can still capture all of that expense. And it's almost really a slam dunk of qualification to show that technical challenge was so high. It's clearly qualified. Even if you abandon the project, we can still claim all of those costs. All right. So Looking onto software, I'll touch on software pretty briefly, but with software development, ERP systems, CRM, a new website, a tool that your customers can log in and make their orders. There's two different types of software that we look at. There's internal use and non-internal use. A non-internal use software, you'll see these 5 exceptions listed here. If you're making a new software that's going to have third-party interaction, if you're going to sell the software maybe to another, related industry or another, type of software that you're saying this is so good we have to start selling it, or if it's in your production process, you're coming up with new automation. That software only has the 4-part test qualification. If it is more of an administrative HR finance tool that you're coming up with, we have a higher threshold to qualify it. That's what we call the IUS, internal use software. So just really briefly, let's say you're coming up with a new warehouse management tool or an HR, program that's going to link in all of your financial data. It needs to have this innovative standard, meaning an intended improvement in speed or reduction in cost. Let's say it's a new reporting tool. It used to take you an hour to pull reporting data from 5 different resources. Now you click one button and it pulls all the information in 20 seconds. That's a really great improvement in speed and reduction in cost. It's faster and you're saving your employee wages. Significant economic risk. There must be some substantial amount of funds devoted to the project. There's no definition of what is substantial, what is significant. We usually find it in the employee wages. It's just relative to the size of the company. And then lastly, not commercially available. It can't be a software that you can just license, buy off the shelf, plug and play. There needs to be some customization, some modification. The example I like to give here is you're probably not going to spend too much time making a new spreadsheet tool when you can just go buy Microsoft Excel. So let's say there is a new CRM or an ERP system that you're putting in place. If you hit that 4-part test, this additional qualification for the internal use software, we can look at a lot of that development time and potentially capture that in the credit as well. All right. Almost as important as getting the project information and running a calculation is going to be documentation. I'm actually going to jump ahead to this slide here. So the R&D tax credit really goes in 3 phases. Qualification, where we're looking at the projects, making sure they hit that 4-part test, they meet the IRS definitions. Quantification, right in the middle, the green column of cost. This is making sure, like Nick mentioned, Sean, with your example, we're now qualifying the project. This new electrolyte formula that you're coming up with does qualify. Now let's get into the details and quantify it. Who's working on it? What are the raw materials? Any contractors? Let's run that calculation, get it into your tax reform, and hopefully be able to utilize that credit and offset some liability. The third and final phase, documentation and support. The phrase that the IRS likes to use is contemporaneous documentation to substantiate the credit. That's a very long-winded way of saying we're not making this up. There are test results, there's meeting minutes, there's business plans, there are vendor invoices that says what testing they're doing. What we like to do is package this all into a report, have all of the information on how the projects qualify, how we're documenting it, really telling the story of how these projects are all qualified R&D, putting that into a nice package for if there ever is an information request or an audit. And I know, Sean, you might have a question about that in a moment, to really try to make it as audit proof as we can. The documentation standard is one area that is increasing over the last few years, but it's a very open-ended definition. There's no requirement of the specific types of documentation. There just needs to be something there that shows this project had technical challenge. This project had this process that we followed. So very open-ended. Nick, you want to add anything on documentation requirements?
Yeah. So we're looking for evidence at the end of the day. The documentation is supporting our claim for the R&D credit by providing evidence. And some of those things, like you see, project budgets. Well, developing a budget, like I said before, that's an accounting function. That's not necessarily R&D, but it is evidence that we were conducting R&D. So anything out there, because of the broad definition, email, attorneys refer to it as evidence mail. We find a lot in email that supports all of these projects. Everyone has documentation for their projects. It's just a matter of finding it and then collecting it. So if you ever end up in exam 3, 4, 5 years from now, for a current claim, then you have that saved in a location that you're able to access, and you really know where it is. Because over time, with turnover, systems getting old and legacy systems going away and everything else, you never know where your data is going to end up. For the R&D credit, you want to store it in one place, keep it with your tax files, and then you'll be in good shape, because sometimes these calculations, current year calculation could be used. We're not getting into the calculation today, but sometimes 10, 15, 20 years down the road, your current year calculation here in 2025 might be used in 2035 or 2040. So it's very important to maintain that documentation.
And we've really seen all sorts of documentation. Like Sean, I'm sorry, we're picking on you a little bit now, but that whiteboard behind you, take a picture of it. That back of the napkin that you had, maybe store that image in an R&D drop folder where everyone can throw some information. We've definitely seen whiteboards. We've definitely seen Post-it notes that we have our clients take pictures of.
I do it all the time. This is like, and I take pictures of it all the time so that, depending on where, if it did this task make it into Asana, was it just a Slack message or was it just killed entirely? But I always like the ability to revisit, go back, because, just this conversation brought up a question around audits in general that are very timely for my company. So I'm like, oh, I'll just jot that down. So I only jotted down Connor's name and the reference over to Kirsten, but that's like future state stuff where I'm like, oh, I might want to take a look at that. So, but yes, 100%. And like, trust me, this is where Hydrate or Die was born. It was born on this wall. The whole idea, hit me and how I could put it together. So yeah, I got you there.
Yep. We usually recommend that if you've got an engineering team or a development team, maybe they have a shared folder or a J drive where everyone can start keeping some data, some documentation, that if you've got some test result that came in and you look at it, you're like, wow, this is a pretty good example of how, we failed a test or we're working towards new benchmarks. Always be able to keep that on hand or be able to reference it. We don't always need to see everything. We like to get a sample of some project information to include in reports and deliverables, but as long as we know that information exists, it's easy to find. What you never want to happen is be 2 or 3 years from now, the IRS wants some more information about a project. We now have to go back and find it. We now have to go back and dig through old legacy files. If you have those stored in one clear location that you can refer back to, it's always going to be helpful. All right, so we included a few examples in the manufacturing space. We included some software examples as well, since we know everyone's got some type of software development activities to improve efficiencies. But really in manufacturing, scale up, batch testing, new products, new SKUs that you're coming up with. There's in the food and beverage industry, really, again, focusing on that flavor development. We see a lot of activity with just new product development in general. But we're happy to answer any other questions that you guys might have.
Yeah, I have a quick question. So when we are accruing, or say we're a company that's not profitable and we have R&D tax credits that we want to use in the future, would we then go back in time and look at our P&L and categorize and figure out what that balance is? Or is a better practice to put it on the balance sheet in some way to be able to submit in the future?
The best practice is to do it concurrently with the R&D. That's not always practical, but at least once a year after year end, to sit down and capture those costs that are associated with it. The wages, supplies, contract research, and any kind of computer rental web services that you have. Because the further away you get from the actual activities, the more stale the data gets, the more difficult it becomes to collect the documentation. And at the end of the day, what we're trying to do is, first calculate it so we can get it onto your tax return, and then document it so we can sustain it on exam, should it ever go to exam. And that documentation, we're trying to tell a story so that an IRS agent reads it and believes that you have R&D and that you've put in your best effort to capture appropriate costs, and you haven't thrown in everything with the kitchen sink into those costs, because that's what they're looking for. They're trying to find um, issues where you haven't followed the regulations or the code specifically. For example, like non-qualified activities. Did you include your marketing related to it? Did you have contractors that were outside the United States? So this is really the reason the congressional intent was to keep the smart people in the U.S., right? So we're gonna spend money in the U.S. on R&D. We don't want you spending money outside of the U.S. Well, it's kind of a boots on the ground test. The individual conducting R&D has to be in the U.S. or territories when they're conducting the R&D. So if you have somebody fly over from Germany and they're helping put together a particular piece of equipment for production, since they are in the U.S. conducting that R&D activity, even though you might be sending a check to the vendor in Germany, you'll be able to qualify that portion of the expenses since he was on the ground in the U.S. And in addition, Talia mentioned there are 35 states with credits. All of them are set up the same way. It's all about, it's location based. So if you're in California and all of your R&D is in California, the qualified expenses will be the same as the federal credit in California and for federal purposes. But if you're split between, say, California, Arizona, half and half, then some of your R&D expenses will go towards the Arizona credit, some of it will go towards the California credit, and all of it will go towards the federal credit.
Yeah, and like really the timeline is the most important. It's really great to capture the detail right after the year ends or in the near future afterwards, because the longer you go without getting that information, you might need it for the future year calculation. So you'll always want to get that data as close in time as you can.
Understood. So as an example, say we're investing in a new piece of equipment that's related to R&D, and part of the expense is the equipment itself, and then the other part, say, is like travel, like a flight to the facility to look at the equipment. That would be on our P&L in, say, like the airfare to do that. So we could essentially, the airfare doesn't need to go into like R&D on the P&L, but we just need to flag that and have that be part of a report. Is that correct?
Yeah, it would be for other items. Unfortunately, airfare doesn't fall into wages, supplies, or contract research.
Got it.
So that particular expense wouldn't qualify. But if it was, one of those, if you're purchasing supplies for the initial run while you're scaling up, you would definitely want to capture that as an R&D supply as opposed to something that's in commercial production and it's regular supplies for COGS.
Yeah, and if you've got maybe a head of engineering who's going to look at a piece of equipment in another state to see, will this meet your technical requirements? He's doing a technical investigation on whether it'll perform for your needs. His time, his wages spent are going to qualify, but the cost of the equipment, unfortunately, and the travel time won't qualify. But any of his activities of, is this going to work for us? Do I have that technical challenge of figuring it out? That's his labor time that we are able to capture.
Got it. I guess I'm trying to look at it from the perspective of like how to categorize and track these expenses over time. Like if it makes sense to put them all into like the chart of accounts as R&D, or if we can, even if they're in another chart of accounts, still be able to organize and have it be easy for tax purposes or audits, whatever.
What we typically see when it comes to P&L or GL detail is there might be a GL account that's exclusively coded to the R&D department. We would then go through and just parse out anything that's clearly not qualified. So if it is travel or lodging or tax or freight, any administrative costs, office equipment, things like that, it might be a desk and a chair going to the R&D team, but we're not able to capture it. So you might just have to mark down like, this is the stuff that we're going to exclude, but everything else, here's the raw materials, here's the supplies, here's the salaries of all the R&D employees that are highly qualified. those are the ones that you would want to, highlight in green and check off as the ones that would likely qualify.
Okay, great. Yeah, that makes perfect sense. Thank you.
All right. I know we're coming up to time, but we do have, a few minutes. If anyone does have any other questions on the qualification of projects or the typical process that we follow to get the information on a tax return, we're happy to answer any questions.
Yeah, Nick and Talia, actually, I had one. You guys did a really good job. I had a few questions, but you answered them throughout the presentation, so thanks. I know you talked about the administrative for like finance, like that's not going to be, you can't, that wouldn't qualify. What about like if you were vetting a consulting group to come in and help on an R&D project or anything like that? Is that qualified or no?
Yeah, that would fall under contract research. And
Okay.
so all of the activities, as long as they're one of those 4 expenses that you can see on the screen right now, you take those expenses and you apply the 4-part test to it. So, contractor might be working on a lot of different things, but a portion of it might be the efficiency, looking at, straightening out a production line. It's going all over your floor right now, and we want to revamp it. It's going to be the same production line, but it's going to have a different footprint, and it's going to go straight through the facility. So trucks can drop things off on one end and pick it up at the other, and there's less handling associated with it. It takes up less space, so maybe you could put in another production line. But they might also be looking at it from a kind of financial perspective and looking at the economics of it. And so again, we would have to take that project or the expenses associated with the contractor and kind of divide all that up. What's qualifying, what's not. Hopefully we get to 80% and substantially all, and we get the whole project. But most of the time we don't get to that 80%. Always looking for it, but probably only get to that, maybe 5 or 10% of the time.
Yeah, and another example of vendor evaluation, if let's say you've got an hour-long meeting with a new vendor and the VP manufacturing comes in to talk about technical capabilities, that VP manufacturing, his time's going to qualify. If the head of accounting comes in to talk more about, costs and efficiencies, that's a bit more administrative. That time wouldn't qualify. So it's really just, putting that line of being able to bifurcate what is technical, what is development focused versus what is more sales, administrative, finance. So that's where we try to divide up the qualified versus not qualified.
What we see a lot is, especially in kind of mid-market and smaller businesses, is the owner is involved, and the shareholders in general are involved in the R&D process quite a bit. And so those are the individuals we spend a lot of time documenting, because when the IRS comes in and says, you're saying your CEO is spending 70% of his time on R&D activity, they're going to get, how could that possibly be? Who's running the company if he's spending 70% of his time on R&D? Well, this is his baby, right? He developed this, and he has other people that he's hired to do the stuff he doesn't like to do. And he really likes the R&D, even though he holds the title of CEO. He is the one conducting the R&D. He is the leader of that. He comes up with the ideas and the requirements, and has support for the business side. And so we look at that as a kind of it's clearly R&D, but it's a kind of a high risk because of the job title. So we just, that's where we focus our time, and our documentation is where we see a lot of risk. It's not going to be the chemist. A chemist's job title clearly falls under R&D, probably spending most of his time on R&D, because what else would he be doing? And so we get a few documents, cover him, got some emails showing that he was involved in some testing. All right, we're good, we're done. But with somebody who is the CEO or COO or other executive level or shareholders, they become the focus of the exam. And again, we just have to spend more time to document it, paper the file, and build a persuasive story that it's the truth is being told.
Got it. Okay, thank you. Sean, I don't know if you had asked you said you had a spicy question at one point. Did you get all of them now?
Okay, I'll shelve it. There's not enough time. We got 2 minutes left, and I got to bounce. So It's always fun. It's more of a boring accounting question around doing audits around traditional like inventory counts using historical data. So I'll maybe follow up. And Connor, if I'm sure Kirsten can get us connected, just drop me an email, or Talia, whomever from your guys' team, and I'll post it as a question there. But thank you guys for the time. The R&D side of this was really what I was curious about, and I'm sure other members of the NSD family were curious about, because we're always tinkering, we're always inventing, we're always trying to come up with something new. And when I look into the time spent on those new products for our brand, very, very little has ever been put towards tax consideration or credit consideration or anything like that. So this is definitely enlightening, and definitely is going to give me a lot to think about. And I'm sure any other brand that's innovating is going to be in a similar boat. So thank you.
So
thank you.
Thank you. Pre-COVID, we used to visit all of our clients and all of our prospects and all of our friends and family, and we would find R&D credits everywhere. Now in the new environment, when we're doing everything over Zoom or Teams or whatever that's virtual, we don't get the opportunity to step foot in the manufacturing floors as often. But when we do, typically we identify a lot more R&D that comes over than it does when it's a virtual meeting. So if anybody wants us to stop by and say hi, I'd love to see your facilities and check out what you're doing and hear your story.
Taste of food.
Yeah, we're happy to taste food.
Nick and Talia, this was incredible. You guys are such a wealth of knowledge. So thank you to echo Sean's sentiments. Everybody here, so many members within Naturally San Diego are constantly innovating, creating new product. So really, it sounds like everybody's kind of leaving some money on the table. Sounds like. Also want to give a huge shout out to Connor for putting this together, and to Jason Padalicchio for his leadership within Naturally San Diego and RSM. I have two quick announcements before we head off. The Naturally San Diego Pitch Slam application is open. So I'm about to drop that link in the chat, and we're having a coffee and combos at Jimbo's next week, next Friday. So I just dropped those two links in the chat. If anybody has any questions, I dropped Nick and Talia's LinkedIn just a little bit ahead too, and I will send out this recording afterwards. Connor, anything else to add?
No, thank you everybody for joining. And again, looking forward to setting up more of these. Hopefully, get some different perspectives, different business service providers, different brands in here to talk about things that are useful. So appreciate everyone joining.
All right, you guys. Have a good rest of your day.